Welcome to Smoke and Mirrors, the podcast that cuts through the noise of the many policies and regulations that affect American agriculture. Each week, we pull back the curtain on the programs, policies, and perceptions shaping the agricultural community in rural America. If you've ever felt like something doesn't add up, you're not alone. I'm Jenny, and this is Smoke and Mirrors. Let's make sense of the maze we call farm policy. Welcome to Smoke and Mirrors, the podcast where we make sense of agricultural policy. I'm Jenny Ift. I teach agricultural policy at Kansas State University. And I'm delighted to be joined today by Mark Dikeman and Chelsea Plummer of the Kansas Farm Management Association. Thanks for being here, guys.
Thanks for having us.
Thanks for having us.
And if we'd like to start off, do you mind telling me a little bit about yourselves and about what the Kansas Farm Management Association does?
Sure. As Jenny said, I'm Mark Dikeman, Executive Director of KFMA. I'll let Chelsea introduce herself here in a bit. KFMA is a joint program between the Department of Ag Economics here at Kansas State and 6 local associations. So our primary focus is to provide financial and production information to KFMA members that help them make better management decisions. That encompasses a wide variety of things. It includes assistance with accounting, which is kind of the foundation of everything we do. If their accounting records are in good shape, then we can provide them a lot of answers. But we also dive into helping them make machinery purchase decisions or land purchase decisions, help them with estate planning, transition planning, really anything financial related. We also spend a lot of time at the end of the year assisting with income tax planning. We take everything that's happened through the year. This is where you're at. This is where we think you're going to end up at the end of the year. And our producers that we work with find that extremely valuable. We also have a sister organization called Kansas Agricultural Tax Services, Inc., or CATS for short, that does the income tax preparation for the producers that we work with. Chelsea, you want to add anything?
Yes, like I said, I'm Chelsea Plummer. I work with Kansas Farm Management as the Professional Development Officer. For about 6 years, I worked as one of our economists, working with clients directly in our Northeast Association, and then kind of moved into professional development and started that full-time last year. So I work then a little more. I still have a couple clients of my own, but I work more just directly with our economists around the state. And I help in a variety of ways. I help with some of the training for new economists, developing continued training for everyone around the state, as well as trying to develop resources that they can use and working with members. I think Mark really kind of covered most of everything that we do. We have kind of our standard thing that when you look at our organization, this is what we do, but we also just build really good relationships with our clients, and that kind of brings on a lot of other work that sometimes we don't always expect. But we build a lot of trust with them, and so that's been kind of I would say part of the backbone of our association is those relationships we build with our clients.
Absolutely. And I have a little bit of background with, I guess, as a sister or brother organization, the Illinois Farm Management Association, that my parents were members of that when I was growing up. And I think that when our representative would come, we'd make a meal for him, and we always liked hanging out with them. So I have some good memories there for sure. Did you mention how many producers you're currently working with?
So there's about 1,800 farm families across the state that we work with. It's kind of hard to measure that number because you might have a corporation with 3 different families involved in that, but about 1,800 farm families throughout the state.
And so I think you all are really on the front lines of helping farmers understand and respond to or plan for policy and regulation from a financial perspective. So I'm just curious, when I asked you to come and talk about this and this idea that I want to demystify farm policy, agricultural policy, did anything pop into your mind, positive or negative? What was your gut reaction?
That is one of the services, I guess you would call it, that we have worked with producers in the past in helping them to understand the farm policy, farm bill changes, things like that. For example, when the initial ARC PLC decision was that 2014, 2015 timeframe, we spent a lot of time working with producers and assisting them in determining what might be the best decision for them. Because it was a bigger decision at the time. It was a longer time frame than what we deal with now. But I think the producers have come to rely on us to be able to provide an explanation of what the latest and greatest farm program is. And so from a policy decision, what happens within the Farm Bill, what happens within USDA or FSA or whatever, it does we do spend an awful lot of time in assisting with that and helping make decisions. Now, we're not going to tell someone what they should do, but we're going to provide some feedback. But to get to that point, we rely very heavily on someone like Dr. Ift to educate us to disseminate that information to the producers we work with. Sometimes that's a very rewarding process. Sometimes that understanding the new programs is very frustrating, especially in this recent era when it's been, to be blunt, more of a shotgun approach and a targeted or longer term program like ARC and PLC might be.
Yeah, and I think so. Like, I kind of came in. So I came in 17, so a few years removed from what Mark mentioned of when kind of ARC and PLC came out and some of those really big changes. And there's been less with those kind of standard programs. There's been less big changes since then, and so that question will still come up on stuff with ARC and PLC, but as Mark mentioned, kind of the shotgun approach of all these ad hoc policies. You kind of asked about that gut reaction. And the first thing I honestly thought of is half the time when these programs come out, even by the time signups come out, even FSA people don't have, and it's not their fault, but they don't always have the best understanding at the local offices of some of these programs. And so I know there's been a couple of them that's kind of left us with trying to put in those missing pieces to help members kind of understand so that when they go in, they already kind of have that base understanding and don't have to ask the local FSA office on some of these programs that have come out so quickly.
Right. And just to back up a little bit, the ARC versus PL decision, this is a decision the farmers had to make since 2014 as a part of the Farm Bill. Today, it's an annual decision. And depending on what you pick and what happens with the markets and yields, which we don't know in advance, you may get a payout. One program might make a payout and one might not. So, there's definitely, risks and unknowns there depending on what they choose. So that's definitely challenging to help people think through what would work best for them with that one. So what are you, I guess, you talked about ARC and PLC. I'd say, like, is that the main concern you're hearing about today related to policy, or is that sort of more in the past? What's at the top of your radar right now?
Well, most recently, I think it's been the questions regarding ECAP payments and just understanding what that program means. In program terms, it was relatively, I hate to say easy, but more straightforward, because we didn't know exactly what the payment amount was going to be, but it was a fixed payment amount per acre. So just educating our producers to understand what the program is and what it means and how it applies to them, and even potentially estimating what they might be able to receive. That was, from the beginning of this year until several months ago, that was a big question that we were answering. And again, a valuable part of what we can do is provide that sort of assistance.
Yeah, and I think I guess, you might get different answers from different economists. I feel like we don't get the ARC and PLC question a lot because they're used to the programs. We might still get here and there like, hey, like I need to go make my decision, but a lot of times we're directing them to the tool that's available for them through K-State that people put together. I feel like more of the questions come from like things like ECAP or the stuff that, in the years that it seems like we have something almost every year. Maybe 24 was the exception, but there's been so many other payments that have come out that I feel like ARC and PLC, even though for them it's probably still a decent decision they're making every year, they're asking us less questions on that.
Yeah. When you think about the questions you get in the different programs, what would you say? What's a part of it that's usually pretty straightforward to address and deal with? And on the same hand, is there something that kind of still vexes you or takes a lot of time?
I think the time comes in just understanding. As Chelsea mentioned, there's not usually, when there is a new program, no one has the answers. No one knows. So sometimes we're just guessing to understand how it might behave, but just educating ourselves so we can educate others is what takes the most time.
I think one of the things I think of that, like with ECAP, wasn't an issue because we knew it was coming out early in 25. But with some of the coronavirus, the CFAP payments that came out a few years ago, it was very unknown if those were going to hit in December or January. So the biggest issue there was tax planning of how do we create flexibility for our members so that our tax plan is not just blown if those hit their banks in December, which a lot of them did. So I think sometimes it can be, depending on the program, the timing of it is what causes some of the headache more than anything else.
Yeah, that makes sense. I know from a educational perspective, there's certain policies that I'll express an opinion on, not because of anything in the policy, but just because it's hard for me to figure it out. Something, like ERP, Emergency Relief Program 2. The first one already had a lot of rules, and this one had more about eligibility. That went through court cases, or you have margin protection insurance, which isn't widely used in Kansas. It's not just a revenue insurance, it's a profit margin insurance. So there's just so many moving parts.
Yeah. And when you were talking about, you mentioned ERP, we also had the Pandemic Assistance Revenue Program. And that one was challenging because there was a lot of work that went into checking to see if people were eligible. And that was something FSA was pretty clear that they were not going to be helping with that piece of it. And a lot of the members maybe had the info they needed by filling out those spreadsheet to see if they were even eligible for that. I would say definitely took a lot more time than other programs like ECAP, where it was pretty straightforward.
Right. Do you see a trade-off with policy? So the pandemic relief program, it was very tailored to an individual operation versus something, say, that's like just a price support. Simple, if price goes below, you get it. The economists, we might get kind of, that might not be efficient from an economic perspective, but that policy maybe is a little bit more transparent than one that's highly tailored to an individual operation. Is this something that you've seen?
Yes, and when we go back to ERP and PARP, especially when we had to dig into financial numbers to determine if someone was eligible, there's always a question in the back of your mind: is someone, are they thinking about this from the future? If there's somebody anticipating that maybe there's a program down the road, things are looking bleak. We have a history of revenue-based programs instead of price support, like you mentioned. Can someone play games with that? Can they tank a year with the idea that potentially they'd be eligible in the future? Those are always questions that we're kind of, I guess, debating, worried about.
Yeah.
Just the fact that those programs are not based on price and they're not based on production. If they're based on revenue, it just it's another layer of complexity that we have to wade through.
Yeah. The backpedal a little bit. Emergency relief program. These were two rounds of ad hoc disaster payments. They were authorized by Congress, and I think both of them effectively ended up being a top up to crop insurance, and then there were some other ways for people to access those funds as well. But this topic of ad hoc payments, I'd like to dig into this a little bit more, because this has been a big feature of farm policy since 2018. In dollar terms, it's become more than the ARC PLC, so the Farm Bill authorized programs. And I think you're probably dealing with these. How do you, from an accounting perspective, so what year do you assign the payments to? Also educating producers, and then maybe planning ahead. Could you talk a little bit about how that's worked out over the past few cycles?
I guess one of the pieces one of the products of our work is a really detailed accrual financial analysis for the producers we work with. With the ECAP payments, the most recent payments, those were, as of the end of 24, we had an idea what those would be, and it was based on 24 production. So we decided to accrue that income, or treat that as income earned in 24, not yet received in 24, but earned in 24, and include that in our farm income our accrual farm analysis. That definitely influenced incomes for 24. Our net farm income average was around 98,000. Of that, 44,000 was those ECAP payments on average across the farms that we published. So dealing with that from an accrual standpoint gives us a different picture than from a tax standpoint. Cash flows at the end of 24 into 25, cash flows were very, very tight for many people. Those payments came at an opportune time from a cash flow standpoint, and dealing with that from a tax standpoint, planning for that. Chelsea mentioned earlier that many times payments come towards the end of the year. We've got to plan around those. With these, we have plenty of opportunity to plan and work through 25, make sure we target where we need to. But unfortunately, I think 25 is going to be depressed enough from a tax standpoint that the tax planning is not going to be the struggle it has been, especially going back to 2021 where, money was just being thrown at producers right and left. And even into 22 and 23, we had to spend a lot of time dealing with these ad hoc payments, planning for them, and making sure that people ended up where they thought they should be from a tax standpoint.
Right. And so I guess maybe we could switch gears a little bit to talk more about taxes and depreciation. Agricultural policy, it's not just about the farm bill or crop insurance, how farmers, and there's different, the laws around depreciation and what you can write off. That changes over time. Is that something you spend a lot of time managing?
Yeah, I feel like we spend a lot of time managing that, talking with producers. We get a lot of questions. Maybe it's, throughout the year, maybe it's something they've already done or they're thinking about doing. But I feel like we get a lot of questions on depreciation and educating, reminding people, there's a lot of flexibility when it comes to a piece of machinery. So usually there it's just talking through what it looks like. And then, sometimes because of machinery purchases, we've got flexibility with the tax planning since we don't have to make those decisions on stuff that we're going to write off until tax time. I think one that I've seen a little more issues with this one in the past few years. I'm not sure why, but if we're talking about machine sheds and buildings, there's a lot different rules that come into play, and the amount people have been able to take on those has gone down each year the last few years with that bonus depreciation, and so that's become for certain entities or certain farmers a bigger issue over the last few years, and some with timing of that because we knew that bonus percentage is going to be stepping down each year. But from a planning standpoint, I feel like that's probably one of the bigger pieces that comes into planning. Yes, we have stuff with like prepays as well, but depreciation is a big one. And, we'll talk about it. Not every producer we work with is doing this, but there's a lot of producers that use machinery towards the end of the year for that tax planning. So I feel like we're dealing with it constantly.
There's also an education piece with that, in that with the Tax Cuts and Jobs Act that basically went into effect in 2018, there was a change in how machinery was treated from a tax standpoint. So under TCJA, or from TCJA going forward, instead of treating a trade at the equipment dealership as a trade, it's now a sale of the old item and an outright purchase of the new item. And it doesn't sound like a big deal, but from an income tax standpoint, it has a very significant impact, or it can. And especially with the inflation or the increase in the cost of machinery, as well as increase in farm size, there's a number of farms now who can't use Section 179 deduction because they've reached that investment limit. And honestly, it doesn't take a lot of trades. If someone is trading multiple tractors, multiple combines, things like that every year, then they are running into a situation where they can't use 179 anymore. Bonus is helpful to make up for it, but as Chelsea said, that's been declining. And that education, that piece of the depreciation puzzle it's taken quite a bit of time or we get a number of questions about that as we go forward. Bonus depreciation it's kind of an all or nothing election. So if bonus depreciation is at, say, 40%, then someone can immediately deduct 40% of the cost. If they elect not to use bonus depreciation, then it's just the normal 5-year or 7-year, 10-year straight or maker's depreciation that they would normally take. With Section 179, they can choose how much uh, the election is made and based on how much they want to take for 179. So there's a lot more flexibility with 179. It can be $1, it can be $1 of a piece of equipment, or it can be everything they paid for it. But with Section 179, there is an investment limit and a dollar limit. So once they reach above that, then they start to lose the ability to use 179. And that's where bonus would come into play. There's no limits with bonus. It's not as flexible, but when TCJA was first implemented, it was at 100%, and over the last 4 years has been declining by 20% a year. So going from 100 to 80 to 60 to 40, that takes away some planning opportunities for us from that, since it has been decreasing.
Yeah, and like the one thing I was just going to add is, we think of depreciation a lot in our tax planning piece, and when we're thinking about these ad hoc payments. But I would say the benefit we have in KFMA is we're also trying to pull it into like a longer term picture for that operation and less of just what their tax picture looks like for that year. So we can pull in, what do some of your financial ratios look like? So yes, maybe from a tax planning standpoint this year, it would help to have that extra depreciation, but is that long term what we want to do? Does that work? Is it going to put your operation in a harder financial spot down the road? And so I feel like we also have that piece of education with our members that not every accountant has the benefit of, just because we're also doing that economic analysis piece as well.
How would you, if you think, this is something, producers, they not managing it is still a form of managing it. So everybody has to manage that, grows the eligible crops, has to manage the farm programs. Everyone has to file taxes. What have you seen from a producer perspective? What's a successful business model or approach for handling changing policy or policy risks?
The economist answer to that is not usually the same as the income tax answer to that. I don't think it's a secret that producers have an aversion to paying income tax. And when there's ad hoc payments that come, they very much appreciate the cash inflow, but at the same time not excited about facing the income tax consequences of ad hoc payments. So I think the advice I would give to someone is think of that as a business decision, or think about things from a business management perspective. And in agriculture, when we have very cyclical incomes, instead of going and buying something to avoid tax, think about how you can position yourself to weather the downtimes a little better. So that likely means paying some tax, paying down debt, putting some cash away, whatever that means for those low income years. I think the economists that work with KFMA are constantly trying to encourage producers to pay a little more tax to position themselves better. And I think some very much listen to that and take that advice. So again, a very different answer from an economist and from a tax preparer. But look long term, like Chelsea said, think about the fact that, I think in 2008 or 9, everybody swore we were going to have $8 corn, $7 corn forever, and that wasn't the case. And while you've got those high profit years, position yourself to weather the storms a little bit. People don't like that advice because it's not very exciting, but I think that's important from a business perspective.
Managing ag policy, successful, business model, whatever it may be. It seems like the farms that do well year to year, just overall management of their business, treating things like a business, And so when these ad hoc payments come in, ag policy changes, they're just kind of a nice surprise. And for those producers, their focus is less on the ag policy and just making sure that they are running their business the best way they can. And so I think there's still some time that they use maybe thinking through some of that with ag policy, in their risk management, whatever it may be. But they're less concerned about what is going to come in from there and just how are they going to make their business successful from year to year, no matter what. And so that's kind of what I thought of. I think they still focus on these ad hoc payments, but it's probably takes up less thought space than maybe for some of these farms that maybe are really struggling and they're needing that specifically for cash flow.
Right. So kind of a control what you can control sort of approach. And I think I have met producers before that said they'll compare their income with and without some of these payments. That might create a little extra work for you all, but it seems like one way to manage the policy risk. Well, thank you so much for joining us.
Thanks for having us.
Thank you.
Thanks for joining us on this episode of Smoke and Mirrors. If today made you think or see things a little differently, share it with someone who appreciates cutting through the noise. Don't forget to subscribe, rate, and leave a review wherever you get your podcasts. Thanks for spending part of the day with us. Until next time, keep asking what matters.